Alright, hello everybody. We're gonna learn about trading stocks by using charting. Start off real quick. Charting is basically identifying chart patterns that have proven themselves to be consistent throughout the market time and time over again. It began by Charles Dow, who was also the man who came up with the Wall Street Journal and who is responsible for the Dow Industrial Average, in case you don't know. He's a very smart man, knew a lot about the stock market. So I'm going to hopefully try to give you some ideas on how to chart. Bear with me a moment while I try to figure out how to get this in full screen. Obviously I don't do a lot of this. Oh, there we go, on your slideshow will be somewhere. There you go. Okay. Alright, so this is charting by me. Alright, sweet. So one of the most basic chart patterns you need to understand is head and shoulders top. This is probably, actually it is the most consistent pattern in all of the history of trading stock charts. Right here you're looking at a chart of Nokia. Sticker is NOK. This is what you see here is what there was a horizontal support line, as you can see from here it tested, and then here it tested again, and during that time it topped out at this price right here. Then it went back down, and then it came right back up to where it topped out right about here, came back down to the neckline, went back up to create the other shoulder, and then went back down. And when we saw right here, we saw it break below that neckline. And typically whenever you have a head and shoulders top, you expect the distance from the price target would be from the distance of the neckline to about right here, which is 450. Our thing was about, what was that, look at 375, and we saw a price drop to $3, which is consistent with what we would expect to see. Next thing we want to do is identify a trend. Right here you're looking at the energy sector of the S&P 500. To be a trend, all you have to do is really have a period of higher high last prices and higher low last prices. And that's what we have right here. As you can see, we have a period where it went up, came back down, went up again, came back down, continued the trend line, went up, hit the trend line, and kept continuing on. That's an easy way to identify a trend. Go up, come back down, hit a spot, come back up, hit a spot, come back up, hit a spot, and each spot is higher than the previous spot that you hit before. Next thing we want to look at is an ascending triangle. Triangles can be a little bit complicated, but it just depends on what you're doing. I hate this computer. Okay, so what you're looking at right here is Delta Airlines stock, and just recently, I just made these charts a couple minutes ago. What you can see is right here, starting the horizontal line, we saw what looks to be, what I'll talk about later, looks to be almost what it's trying to look like is a double top right there. And then right here, when we came back here, we saw a little bit of pretty weak pressure. But this is what is important. When we saw this horizontal line right here, we saw it come back down here, touched here again, come back down, come back up there, come back down, and then when we came back up here, we saw a break above, and then your price target is $19 minus 18 minus 1.5 equals 17.5. So that gives us a price target of about $20.50, which when we saw $20.50, we also saw a gapward up, a gap trade up, and we'll talk about gaps probably in a different video. Next thing we want to talk about is the symmetrical triangles. These things are awesome. Alright, they happen all the time. And what we see here is you're looking at a very nice uptrend of McDonald's. However, what you see right here is you see what looks like to be top line resistance, and it goes to the downside, where we also see buying pressure coming in a little bit early. So this is a textbook version of a symmetrical triangle where we have a high, a lower high, a lower high, a low low, and then a higher low. And then right here what we saw was a break. And on the break, what you usually want to do is you have your price target, which is going to be, in this instance, is going to be, looks like to be 103 minus 98, so that's $5. And we had our break at 99, so we would expect this stock to go back down to about $94, which is pretty consistent with what we saw here. It went down to 95. It didn't quite make it down to 94, but McDonald's will probably go down to 94 sooner or later. Except for that gap. That gap can probably that's a game changer, but that's still very close to textbook what you'd expect. Next thing is flags. The notice thing you'll notice different here is I actually put in volume, which is pretty much the only indicator I ever look at. And what you see here is we have a very, very nice, well-defined uptrend in Bank of America. So that began in about July, August 2012. So, you know, that was about, oh wow, that was a year. Wow. So, anyway, so we had a really nice uptrend that's going, represented by this green line. Then these blue lines that I have drawn here represent what is known as like a flagpole. These red lines are the flag, and we have another flagpole and another flag. Right here, I circled right here where we saw a volume surge. Now we saw the volume surge because it confirmed that we were having a flagpole with the 1, 2, and then the third test is really what gave us the trend runaway. And then when we saw here, we saw some volume traded to the downside, and we also noticed at that same time we had a volume spike. And then right here we also had a volume spike again, and that was also to the downside, representing the beginning of an uptrend. So everyone was trying to sell out before they, cover their short positions is basically what they were doing. And then right here we have a second one. It's not as good as well defined as the other one, but it is essentially the same thing. And then it looks like right now Bank of America is creating another flagpole, and we could probably see a flag later on. That tells me that Bank of America, from a long-term investor's perspective, is that this is a very fractal stock and very much chart-driven. So that's one of the reasons why it has so much volume every single day. Next thing we want to look at is a pennant. Pennants are a little tricky because they look. What a pennant is it's basically like a triangle within an uptrend. The only difference being they're given a different name. I mean, it's really not that complicated. But what you're going to look at, you're going to see I'd have driven a horizontal line where we had either top line support or bottom line support. Right here we had support here, or top line resistance. What I think I said. Anyway, so we have support here where we bounce back up. Then we had a period where the bulls and bears fought. The bears obviously won. They came back down. Right here, obviously, this is a very battleground price. Right here, about $18.90, between $18 and $19. And right here we have where the price was able to surge up, where the bulls for a brief moment got up to 21. Then came back down to that neckline, and then came right back up here, and then went up again a third time, each time falling down to that $18.75 price. And one thing to notice that you can always find that especially distinguishes a pennant from, let's say, a normal triangle is that if you take this whole triangle out and just follow my cruiser right here, it's just one large triangle divided into two. And usually that is an indication that if you do have a downward trend right here, that is a bullish indicator, and you could actually expect price target from what it looks, we'll call it $19 to 21 is 2. So when we see the break here, we see 21, we should add another $2, which would put us at 23. And what's interesting is when we got to $23, we had a period of basically a fighting period between the bulls and the bears for about a month, and the bears obviously won. Alright, the next thing we're looking at is a wedge. AAMRQ, one of the best investments I've ever made in my life. As you can see, I bought this stock back in December when this was about 50 cents. And I sold it a little early. I sold it right here for like $1. However, if I would have held it, I would have made a lot more money, but it's okay. So what we're looking at here is a wedge. We obviously began a very, very nice uptrend right after this gap up. Right here we had a huge volume. They announced some kind of buyout deal with US Airways or something like that. Anyway, so because of that, they had a very nice gap where it move up, followed by a very nice uptrend, and we also had a top line uptrend as well. And what you can notice is that right here, that's a very small distance. Right here, the distance between these two lines is larger than the distance right here. Distance here is larger than that and larger than that. Therefore, because we have a period of expanding lines, that's called a wedge. And what that indicates is that the buying pressure is more cautious, is the best way to put it. And so, although you can probably still expect this company to keep its uptrend, which it looks like it did break and it's trying to salvage it back, I'm more inclined to believe that it will salvage it back. But because of the wedge, that just means that there's a lot of uncertainty with it. And one of the biggest things about charting is you want to be convicted to make a chart. And I'll talk later about it whenever I have more time. But yeah, that's just a little bit of an introduction. Don't judge me too hard. Thank you.